Hello, and thanks for joining us. Private equity is a term that we hear all too often in the world of dentistry today. Yet we find that many people don't know who private equity is, what their objectives are, and why they're so interested in the dental space to begin with. Hopefully this video will answer many of those questions in the minds of the viewer. I'll start by giving you a quick overview of exactly who we are and what we do so you'll understand a bit more about our background. That's me in the middle. I'm Perrin Desports, and those are my two partners, Diwakar Sinha and Kevin Kumbas. Kevin got his start in investment banking with Wachovia Securities. After business school, he spent 4 years with the McGill-Hill Group here in Charlotte, North Carolina, focused on practice transitions and valuation. After leaving the McGill-Hill Group, he did 4 years with Affordable Care Incorporated in their DSO operations and roll-up strategy. Diwakar is the banker in the group. He spent the last 15 years of his working career lending money to dentists all over the United States. Most recently, he was Vice President of Sales for East West Bank out of Pasadena. East West was the preeminent lender in the emerging market DSO space of dentistry. And I've got 15 years of distribution experience, having run 3 different operations for Patterson Dental Company. There are 2 facets of our business here at Tusk. The first is an online brokerage website. Think Zillow.com meets dental practice brokerage. Until now, if you wanted to sell your dental practice, you basically had 2 options. You can pay a broker 10% to sell your practice, or you can go it alone and do it in a for sale by owner model, neither of which are a really good value proposition. We leverage modern technology to reduce our costs and pass those savings on to our sellers, and we charge 5% commission to do that. You'll see that our listings feature beautiful professional photographs, informative graphical displays of clinical, financial, and operational successes, and much, much more. We think more engaged buyers hopefully means more offers and potentially a higher selling price for our sellers. It's a wonderful value proposition. You can see more examples of our listings and get further details at tuskbrokerage.com. The second facet of our business, and really what we're going to dive into more tonight, is on the Tusk Partners side of the business. This is focused more squarely on group practices and DSOs, especially those in the emerging market. Think 5 to 25 locations. Your legal structure is critically important, and you need to define it early on in your DSO because it impacts equity and exit considerations as you scale your business. Debt structure is something that not too many emerging market DSOs consider until it's too late. Traditional lenders typically pull back around 4 locations and roughly $2 million in debt exposure. So we help them find alternative sources of capital. You can learn more from our white paper on our website called Debt Financing in the Emerging DSO. We offer buy-side advisory services and sell-side advisory services. Most DSOs will grow through acquisitions, so they frequently come to us and ask them to find targets to acquire. Then we do some quantitative modeling to determine the upside of the acquisition as it fits within their DSO. On the sell-side advisory, this is really more of a go-to-market strategy. It's about a 3 to 6 month process where we prepare the business for sale operationally and financially, trying to show it in its best light. And then we take it to market to find the best partner or acquirer, be it private equity or an enterprise level DSO. To go from small to medium to large takes a little bit of hand holding, and our strategic consulting offering is geared toward that end. Our engagements typically last about 6 to 36 months, and they're designed to help a DSO grow and scale their business to the point of preparing for sale. You can find more information about these services as well at tusk-partners.com. So now that you know a little bit more about us in terms of who we are, what our background and our experiences are, let's dive a little bit more into private equity and determine what exactly is private equity. A private equity group, or PEG, is basically an investment fund. The fund is set up and run by directors and managers, and these people typically have deep industry experience in certain sectors of the overall economy. They gain this experience by working for larger companies in their history, typically investment banks, banks like Goldman Sachs, for example. The directors and managers of the fund will put together a prospectus or a business plan, and they'll take that out to a lot of their industry contacts and indicate what sector they want to focus on making investments. They'll also talk about the time horizon and the amount of money they hope to raise. This money will typically come from a variety of sources: pension funds, institutional investors, and high net worth individuals, also known as limited partners or LPs, will make up the bulk of the investment in the fund. These funds typically have about a 10-year horizon. That means there's a beginning point where they're trying to pull together capital. There are a number of years where they're making investments, deploying that capital, and then on the tail end, they're selling those investments, usually for a premium, and returning money to their investors. They typically invest in about 8 to 12 different portfolio companies per fund. They buy companies in the first 5 years, and then they sell companies in the second 5 years. And they typically hold a portfolio company from about 4 to 7 years in length. So how do private equity groups generate returns for their limited partners and investors? We're actually going to work through a math example of this in a few minutes. But as an overview, they're very disciplined and they buy companies at reasonable prices to begin with. They're savvy operators. As I said before, they have deep industry experience and a lot of contacts, and they improve operations to increase profits. They expand their corporate governance and the infrastructure to support internal growth. And then they build scale and efficiency into the companies that they buy by continuing to make acquisitions and investing capital to support internal same-store sales growth. At the very end, they successfully sell these businesses at a higher valuation than what they originally paid for them. A typical private equity group expects to generate about 3 times their investment over a 5-year period of time. Another way of saying that is that their objective is to triple their money every 5 years. I mentioned at the beginning that private equity is such a popular buzzword in today's world of dentistry, and that's predominantly because 9 of the top 10 DSOs in our industry are still private equity backed. You can see the list of them in front of you, and Pacific Dental is really the only one that's still privately held at this point. So what exactly is happening in today's world of dentistry? Well, there's a massive roll-up of dental practices occurring across the entire dental economy. You see this at the top level with some of those that I mentioned on the prior slide, the Heartland Dentals, the Aspen Dentals of the world, but you see a tremendous amount in what we term the emerging middle market. Think 5 to 25 locations. Truthfully, this is the fastest growing segment in the entire practice of dentistry, and it's a segment that private equity is incredibly interested in. The trend began about a decade ago, and it continues to accelerate incredibly quickly. Most industry projections have it at about 15 to 22% in terms of overall consolidation. Well, why are DSOs and private equity buying dental practices? For those of us who've been in the business of dentistry for a number of years, we pretty much term dentistry as a recession-proof industry. While other industries are taking a nosedive and seeing 20 to 30% attrition and massive valuation erosion, a bad year in the practice of dentistry is basically being flat year over year. There are also economies of scale that are in play, and they take effect the larger you get in terms of the number of groups you have, a number of practices you have in your group. And finally, dentistry as an asset class is seen as less risky than other healthcare investments that private equity would otherwise make. You can think about this in terms of the absence of all alternatives. Dentistry is a very stable, very profitable endeavor, and that's not lost on our private equity operators. So we're going to work through an example of how private equity makes returns, and you'll see the math play out in just a few seconds. But before we do, I want to make sure you're aware of a term, and it's a term you probably will have heard by now, called EBITDA. EBITDA is an acronym, and it stands for Earnings Before Interest, Taxes, Depreciation, and Amortization. It's basically a way of normalizing profit between two similar businesses by taking out a lot of the non-cash deductions and unnecessary expenses. It's a way of normalizing operating cash flow. The easiest way to illustrate why private equity is so interested in the business of dentistry is to work through an example of how value is created. We're going to do that right now. Let's start with a typical $1 million practice, $1 million worth of collections. It's split 70-30 between clinical and hygiene, and this practice has an overhead rate of about 60%. If we normalize it for clinical compensation, we're going to say that we pay our dentists 30% of collections. And this leaves an entrepreneurial profit of about $190,000 for this particular business. Now, if this business were bought and sold by a traditional broker, they would probably value it at about 80% of revenue, meaning the business would sell for about $800,000. That happens to be a 4.2 times multiple of EBITDA. So let's say we own the practice the $1 million practice that we just mentioned on the prior slide, but we don't want to stop there. We want to grow our empire. We're going to add 6 more practices and form our own little DSO. The practices you see here, numbers 2, 3, 4, 5, 6, and all the way up through 7, are set up the same way as the one on the prior slide. They bounce around about $1 million worth of collections. They're split 70-30 clinical to hygiene. They all have a 60% overhead rate, and we're paying our dentists 30%, same as in the prior example. We're going to value all of these through traditional broker means of about 80% of revenue. And as we buy those individual practices, numbers 2, 3, 4, 5, 6, and 7, we're going to end up with a total cost of about $5.5 million for our 7 location DSO. But we're not going to run those 7 locations as individual dental practices. We're going to run them as one collective business, a DSO. When you pull together that many locations, generating that much in terms of collections, you get some cost reduction and overall business improvement. Specifically, we'll take a look at a couple of different areas here. For one, a group practice of 7 locations can probably increase its collections by about 5%, very conservatively. They do that through renegotiating insurance reimbursement rates, possibly raising some fees, expanding some services, pouring some capital on a marketing program, and expanding insurance businesses across the board. In this example, again, we're looking at our entire entity and we're still keeping that same 70-30 clinical to hygiene ratio, but we're going to take 5% out of the overall overhead rate, dropping it from 60% to 55%. We're going to do that, we're going to achieve that by removing some redundancies and some overlap in teammates. We're going to centralize some services. We're probably going to negotiate a lower lab bill and our dental supplies with our supply company, cutting about 5% out of our overhead. However, we're going to have to put some costs back into the organization. At a corporate level, we're probably going to need a CEO and a handful of other personnel people, maybe a controller function or a centralized marketing function or a regional operations specialist. So we're going to put about $350,000 worth of salaries back into the business at a corporate level. After you adjust for that and the lower overhead rate and take into account the increase in collections, our net EBITDA now is almost $1.6 million. And that's actually a 20% increase over running the practices individually as 7 different locations. After we've proved that we can successfully run our 7-location DSO, we're going to take it to market and sell it. And a group dental practice with about $1.6 million in EBITDA is going to fetch somewhere between a 4 times and an 8 times EBITDA multiple in the open market, in today's open market. So we're going to use a valuation multiple of 6 times EBITDA, which is right down the middle for our sales example here. A 6 times EBITDA multiple, when your EBITDA is 1.578 million, yields an enterprise value of almost $9.5 million. Now, if you think back to 2 slides ago, we said that we had about $5.5 million in acquisition costs to buy those 7 locations. We've got $5.5 million of costs in it and a $9.47 million enterprise value with a difference of almost $4 million. And that's a return on investment of 172% that you can see on the right-hand side. Well, when we sell our group dental practice, in this case, we're going to say that we sell it to a private equity investor. They bought our platform for 6 times EBITDA, and they paid $9.47 million to acquire it. But they're not going to stop there. They're going to use our DSO platform as a starting point to make subsequent acquisitions. As a matter of fact, they're going to go out and buy those 7 individual locations similar to what we illustrated in a prior slide. They're going to pay the same amount to acquire them, the 80% of revenue multiple that we showed before, or 4.2 times EBITDA. And their cost to acquire all 7 of those locations is about $6.6 million. Over the next 5 years, they're going to focus on running and growing the business and improving EBITDA by about 5% annually. So if you look at the starting EBITDA of the business that we have, the platform they bought from us, and then the 7 individual acquisitions that they made, the combined EBITDA is about $3.157 million. They improve it 5% per year, and in year 5, they break the $4 million mark. They've spent $16 million to acquire businesses and grown them over the last 5 years, and now their investment is putting out over $4 million in EBITDA. We call this phenomenon dollar cost averaging down, and it brings their investment multiple down to 4 times in this scenario. Remember one of the prior slides when we talked about what their investment horizon was, and we said that in a fund it typically lasts 5 years. They buy businesses in the first 5 years, they run them, and then they sell them in the second 5 years. And they typically hold portfolio companies between 4 and 7 years in terms of duration. So in this example, after they bought the platform, added 7 locations, and then ran it and improved it over 5 years, now it's time for them to sell it. And a $4 million EBITDA group practice in today's market would probably fetch somewhere between 8 and 12 times multiple. Remember that I said for the business that we sold to private equity originally, it would probably fetch between 4 and 8 times multiple. We use 6 as an example there. In this situation, they've grown the EBITDA beyond $4 million, and they can expect a return between 8 and 12%. In this illustration, we're going to use 10. It's right down the middle. So a 10 times multiple on a $4 million EBITDA business is going to yield an enterprise value of over $40 million. We said they had $16 million of cost in the enterprise, leaving a difference of over $24 million, or a 250% return on investment. You may also recall that I said that private equity's objectives is to triple their investors' money in 5 to 7 years. This 250% return on investment that you can see on the right-hand side of the page is not outlandish, it's not unexpected, it's probably pretty accurate and fairly normal. And this is why private equity is so interested in the dental economy these days. And as a final proving point and an example, we've got a list of merger and acquisition activity in the dental space over the last handful of years. I want to bring your attention to 2 trades that went off. One is the Linden Capital acquisition of Gentle Dental, and compare that against Blue Sea Capital's acquisition of Decadental Group. Linden Capital in October of 2012 paid 9.8 times EBITDA for Gentle Dental. Gentle Dental's EBITDA was $8.2 million, so the purchase price on the trade was $80 million. Again, they paid 9.8 times in October of 2012. Not even 3 years later, Blue Sea Capital paid over 18 times multiple for Decadental Group. Decadental's EBITDA was about $7.4 million, and the enterprise value was in excess of $130 million. And if you look at the right-hand side of this chart, you'll see the EBITDA multiples growing over time. Again, to be expected in today's world, not indefinite, but certainly normal returns that we're seeing for private equity-backed groups and acquisitions. So as we come to a conclusion on this initial webinar, how can you stay connected with us? In the deck that you downloaded, and if you keep it in PDF format, you can actually access some of the links on it. If you want to refer a friend or a colleague who might benefit from this webinar, let us know and we'll send them the link. If you want to continue to grow your knowledge of the DSO space, our blog is a great wealth of information and you can subscribe right there. And if you're looking for an industry expert to provide DSO related content, we speak at seminars, trade shows, customer events, study clubs all the time. We can provide content for a remote hosted webinar or a series of them. We can co-author content for a blog, trade publication, white paper, ebook, or otherwise. You can download our speaker and PR packet off your PDF as well. And if you have questions about any material we presented in this webinar or others and want to drop us a line or give us a call, our direct contact information's on the next page. You can send an email to me, DeWalker, or Kevin directly, or feel free to call any of us. And on behalf of all of us here at Tusk, thanks so much for your time.